Hey everybody, and welcome back to another video here on the channel. My name is Brandon. If you're new, if it's your first time here, be sure to hit that subscribe button and also click that first link down in the description below if you are a beginner to the stock market and you're looking for a place to learn. But I did get a question actually through Facebook the other day asking, what are your thoughts on the golden butterfly portfolio? And if you're somebody that's never heard of this before, well, what you're looking at on the screen is exactly it. And as you can kind of see, it gets the name because we have one wing or one section dedicated to stocks. We have an equivalent wing made up of bonds. And at the head of this portfolio, we have a head of gold. Hence the name, the golden butterfly portfolio. And the objective of this portfolio, quite simply, is to go out and achieve similar or very similar returns to a broad US equity portfolio, like a total US market portfolio, but with substantially lower volatility. In other words, we're striving for the same results, but totally smoothing out the ride, totally trying to cut out the ups and downs that a normal equity portfolio would have. And to break down the portfolio one step further to its actual asset allocation, we'd have 20% or 1/5 of the portfolio dedicated to large cap stocks. We'd have 20% dedicated to small cap stocks, 20% allocated to short-term bonds, 20 to longer-term bonds or longer-term treasuries, and the final fifth, the final 20%, would of course be weighted to gold. And it's interesting because you may be thinking to yourself like, hey, isn't gold a risky asset, or small cap equities? To have a fifth of my portfolio in small cap equities, you could even make the argument that long-term bonds, long-term treasury, there's a lot of uncertainty there with what's going to happen over the next number of years with interest rates. These assets alone, when looked at one at a time, you could consider risky. Now, when you compile them together and you look at something, and what we call correlation in the investment industry, it's a bit of a different story. And this actually reminds me a lot of the portfolio made famous by Ray Dalio. It's called his all-weather portfolio. There are actually a lot of similarities, but the idea with the different asset classes in this combination is that the portfolio is built to handle all of the different economic environments, all of the different areas of the market cycle. You take, for example, during times of prosperity, well, that's awesome because the portfolio has a 40% exposure to equities. In particular, the 20% to small caps are going to do just great. Now, during recessionary periods, we have the fixed income component, a big chunk, over 40% of the portfolio in fixed income, which has historically done well during those periods. It will offset the losses in the equity component. And of course, as a hedge to inflation or an asset that typically performs well during tough times, we have gold, the 20% exposure to gold. So that all sounds great in theory, but let's take a look at the actual performance and see how that pans out. And the benchmark that we'll use to compare this, like I said, is just a total. We'll use the Vanguard Total Stock Market Fund, US Stock Market Fund, which is VTI, essentially taking a wide array of US equities. Here's just a little portfolio analysis that I ran. We see in portfolio 1, we have the exact ETF VTI representing 100% of the portfolio. And in portfolio 2, our golden butterfly portfolio, I've just went out and picked a variety of ETFs, one giving us exposure to our large cap stocks, one giving us exposure to our small cap stocks, short-term treasuries, long-term treasuries, and then an ETF for gold. And what we see by looking at the performance of these two, and unfortunately this projection does only go back to 2005 because of the funds I was using. I will show you a longer term projection in just a second, but very interesting to see that the golden butterfly portfolio actually did a pretty good job of keeping up with the broader US market. In fact, by highlighting the compound annual growth rate, the CAGR, we had VTI growing at a rate of 8.6%. And not far behind, we had the golden butterfly portfolio posting a gain of 7.59%. Now, what's really telling about this projection here is this column with the worst year. The year that the portfolios performed the worst, the broad US market saw a drop of 36.98%, while the Golden Butterfly portfolio saw a drop of 4.12. And by just taking a look at the chart here, we see that discrepancy, we see the difference. And of course, during this time period, we're talking about the financial crisis, 0809, a drastically different situation in terms of the volatility, yet in the big scheme of things, a very similar return. Now, for some longer term data, to look at a bit of a bigger time frame or a longer time frame here, this source is taken from portfoliocharts.com. This compares the US total market, in other words, let's say VTI, to the Golden Butterfly portfolio. And the long-term compound annual growth rate, we see 5.9 versus 5.7. Not a very big difference there over a long sample size. This goes back to 1972. Now, the best year will of course be better with our equity portfolio when we have exposure to the broad market, but this number right here, the worst year, 37.1 versus 11.7 on the Golden Butterfly portfolio, with a drawdown period of 13 years versus 2 years. So a very interesting portfolio, a very interesting concept without a doubt. And the data here that we're looking at, it's quite telling that if you're willing to give up a little bit of gains, and really over a long period, looking here like a little bit of gains, each of these different asset classes, they all do their thing, all at their different times in different economic periods, and it clearly reduces the overall swings of being an investor. And it's not a portfolio that I would personally go for. I'm quite content with my own strategy right now. A very simple 80-20 strategy where I'm out picking stocks. That's what I personally enjoy and love. But it is one that may warrant more research for somebody that is obviously a little more conservative. If you're not comfortable with seeing such heavy swings in the market, maybe somebody that's a little bit older and you're deciding, hey, how should I structure my portfolio? Maybe the Golden Butterfly one is one to look at. And I don't know exactly why, but something about me just wouldn't want to hold 20% of my portfolio in gold, despite the data here showing, I mean, hey, at least over the past 50 or so years, been a pretty respectable return. One of the things that may be a bonus, if you haven't checked out what Ray Dalio came out and said in one of these recent articles about the paradigm shift, he did mention that commodities such as gold may be beneficial to hold in a portfolio. They could be poised for a nice next 5-10 years, which of course would be a major benefit for a portfolio like this. But as always, this is not a suggestion to simply go out and mimic this portfolio, but just an idea for you to go out and do a little bit more research on. If you enjoyed the video, feel free to give it a thumbs up. And like I said, subscribe to the channel for more content. We post videos like this every week, and make sure you hit the bell for notifications. If you are a beginner to the stock market, if you're not really sure what all this means, or you're just looking to get your portfolio set up, looking to build a portfolio, a diversified portfolio the right way, you can learn more about joining our Investing Academy. We're helping beginners go from absolutely nothing to getting their portfolios built, in many cases in less than a week. You can find out more about that down in the description below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.